Another old-fashioned book that I'd like to share with you is written by a man that invented a lot of things. His name is J. Wells Wilder, W-I-L-D-E-R. I had the opportunity as a young man to actually spend time and meet Mr. Wilder because he was also a student of Wyckoff and worked with my dad. He invented some very creative and unique properties of charting. And the book I'm recommending is only for those of you that are technical and like dull reading. But there's a purpose behind the technical and the dull reading. Mr. Wilder invented something called average true range. He invented something called relative strength. And he invented a number of other basic core charting methodologies that you'll recognize as you read this book that are now mainstays of charting. But what's interesting is that what Wilder did is create these studies off of 4 key variables, and they're Floydian variables, which is why I like him. Open, high, low, and close. The open of the market, the high, the low that day, and the close of the stock or the option. Wilder, Wyckoff, and Floyd, we all believe that everything around the market can be averaged around the open, high, low, and close. In our option count services, where we teach you how to count the value of bell curve bias to the positive or negative put or call, we teach within that using the open, high, low, and close, and doing a charting methodology and actual calculation that we teach within our services that shows you the bias of the day. Much of my work came from Wilder's initial equations and methodology. What Wilder did, and what you'll see in this book, is chart all of this mentally. He would create open, high, low, close data. He'd pull all that data and then create various spreadsheets. But I want you to recognize that he did these spreadsheets before there were spreadsheets. This was all work done in the 40s and 50s. He did this manually and had the opinion, rightfully, that by studying information and extrapolating it manually, he was able to find and see historical patterns. So I recommend New Concepts in Technical Trading for one reason only: to see how a mathematician thinks. Much of what Wilder came up with is what I now use in my Floydian logic, which is game theory. Mathematic game theory is just the law of averages and knowing when the moving average, that's the average of a certain number of days of the open, high, low, and close, will shift. Good book to read. Read it in relation to Reminiscences of a Stock Operator so you can see how somebody read the tape back in the 20s, and you'll get a feel of how the history of the market created what could and should be done today.